Right, welcome back. So, fundamental analysis, this is an important one. This video might take a bit longer, so bear with me, right? But let's jump into it. So, what's fundamental analysis? It's basically understanding the business before you buy it, right? And three main things that I look at is what is the business? What is its profile? What is its revenue? How does it generate money? Who is its products? What's its competitive advantage? And what is the business worth over the long term, right? And I myself, I have this four-step checklist. So first of all, the business profile, whether it has a sustainable competitive advantage. Secondly, the financial health, right? It definitely needs to be growing, positive revenue, positive net income, for example, and he must have a healthy debt. And then the third one I look at is the future earnings growth potential of the company, right? Because a company can be very strong over the last 10 years, but maybe it's going to weaken. There's no more growth. It's plateauing, for example, right? And then once you do all these three, then you look at the valuation, whether the stock is cheap or expensive. So let's jump into it. So the first one is on sustainable competitive advantage. And in my view, there's five that I look at, right? So the first one is intangible assets, right? If the company has brands, patents, or licenses, things which the competitors cannot easily copy, then it has a competitive advantage. The next is switching costs, right? So it's very hard, or if it's very timely, there's much money involved, or there's risk to change providers, then it also has a competitive advantage, right? Network effect. So if more and more people use it, for example, if you think about social network such as Facebook or payment systems such as Visa, for example, more and more people use it, it has a stronger network effect, right? And cost advantage. So if the company can produce much cheaper than the competition, is able to have strong bargaining power, it can negotiate cheaper raw material prices, for example, or it's very efficient, it's using a lot of AI or a lot of automation to streamline its processes, then it also has a competitive advantage, right? And the last one is on the barriers to entry. So if there's any regulations that's involved, or for example, it's very, very capital intensive to enter this business, then it also is very helpful for this competition, right? So great businesses, they are like a castle, right? So I have the Barkley castle on the left, but they stay great because the competitors cannot copy them, cannot switch away, cannot match their skill, for example, can't beat their network, or can't even enter this market, right? So a strong company is one that has a very strong competitive advantage. Right, I think it's best to use a real life example. So in this case, let's take a look at Coca-Cola. So I basically rated this different criterias on the score from 1 to 5, right? 5 being the strongest and 1 being the lowest, right? So in terms of intangible assets, right? Coca-Cola, I think everybody knows it, right? It's a long business, many, many years to build that trust. You can copy the drink, but you can't copy the brand, right? So in this regard, I gave it a score of 5. Switching costs. In this case, it's a 1 to me, right? Because people can switch easily. Can always choose another drink, right? There's no contractual obligation, nothing, there's no penalties if you don't drink Coke, right? So there's nothing that is really stopping the customers from switching. Network effect. In this case, I'd say like 2 out of 5 because more people drinking Coca-Cola doesn't directly help the business, right? It's not really like social media. But of course, being everywhere and having that presence, that marketing presence, definitely helps the business, right? Because people keep choosing it, right? So it's not a network, but of course, being everywhere does help the business. Then the cost advantage. So in this case, Coca-Cola is huge, right? They have large economies of scales. They have long-term contracts with their suppliers, for example. So in this case, it can always outspend and outprice smaller brands easily. And the last one is the barriers to entry, which I also rated like a 4 out of 5 because it is not hard to make a soda, but it's very, very hard to replicate Coca-Cola's distribution, its contracts, and especially its marketing dominance, right? And it's capital intensive to enter this industry as well if you want to make it to scale, right? So out of 25, basically my score was 16 and I'll give it a narrow mode, right? So I have a scoring criteria on the top right. 18 to 25 to me it's very wide. It means that it's so strong, it's so durable, it can protect its profits. 13 to 17 is narrow, and then anything under 13, honestly, I don't bother, right? Because this company has no moat, right? It's easy to compete. And of course, there are many free resources out there that you can use, for example, to understand the economic mode, right? So this is by Momo. It's not sponsored. I'm not sponsored by Momo, but in this case, under the valuation tab, there is the Morningstar research that allows you to, at a glance, look at the economic mode, right? And in this case, Morningstar gave the economic mode of Coca-Cola as white, right? A bit different from mine, but still pretty similar. And of course, there's many texts and many things that they are writing here, so it's important to do your own due diligence and read through and understand why the particular analyst give a white mode, right? But this is a free resource that you can use if you have a mobile account, right? So this makes it much faster for you to do such analysis. Okay, so moving to the basic accounting 101, which is important. I know it's boring, but important to cover. So imagine you have a business, right? So your businesses are split into two things, assets as well as liabilities. And assets are things that your business own. So for example, any inventory, any cash, right? These are things that the business owns that helps it to generate money. And it's split into two types. One is current assets and one is long-term assets, right? So current assets are things within a 1 year time frame, for example. And then long-term assets are things that you use for many years. So for example, any machines, any vehicles that depreciate over time, right? And then of course businesses have liabilities as well. So there's loans that are needed to be paid, any debts and obligations. And it's also again split into two types, short-term liabilities as well as long-term liabilities, right? And this is important because it basically helps you to understand the business at a glance. And then coming to the income statement or income side of things, again, imagine you have a small shop. You're, for example, selling 100 t-shirts at $20. So in this case, sales is 2,000, right? Nothing has been deducted, no cost has been deducted yet. And then you need to spend money to run the business, right? So you need to rent a place, you need to pay your workers' salaries, you need to run advertisements, for example. So you imagine if you have a total cost of 1,500, your profit, your gross profit is then $500, right? And there's this term that is used in accounting which is called EBITDA, right? And it's basically earnings before any interest, tax, depreciation, and amortization, right? And this allows you to compare companies fairly from company A to company B. You compare the operating profit before all the accounting noise, right? And then the last one is net income. So it's your final profit after you deduct all your expenses, you deduct every other expenses for the businesses. That is your net income. Okay, and of course, another element is to look at is cash flow, right? So if your business is profitable but it's not generating cash, it's difficult for your company to survive because you're not able to pay salaries or pay bills on time. And the last one is debt, right? And debt can be useful and can also be bad, right? So it is good debt is, for example, is helping to grow the businesses. You are reinvesting the loans that you're having to do R&D, for example. Those are good debt, right? Because it's helping to generate future earnings and future profitability for the company. Debt can also be a bad thing if you're taking too much debt, especially in the last few years where there's high interest rates, right? You need to pay a high interest expense, right? So you need to balance between having a healthy level of debt, right? So profit is important. Cash is what keeps the business going. It's the lifeline of the company. And then debt adds risk to the business if it's not managed properly and carefully. So in terms of the financial health checklist, I have two. The first one is the revenue growth. So is the company selling more stuff over the last 5 to 10 years? If it is, it's good, right? If the revenue is not consistently growing or it's even falling, then it's a warning sign to me that, hey, look, maybe people are not buying more of these products, right? And more research needs to be done to understand why. Second one is the net income, right? So after deducting all the expenses of the company, is the company actually making more profit over the last 5 to 10 years? If it does, it means that it's able to price its products well and it's able to control its costs, right? Because imagine if you are earning a lot of money, but you are spending recklessly, right? Then there's pressures on your net income. And then the third thing I look at is the operating cash flow. So is the business really generating cash, right? Is there really cash flow for the business and not any accounting manipulation that is being done? Because cash is what is the lifeline of the company. It helps to reduce debt, pay dividends, and even fund buybacks if necessary for the company. And then once I look at those three, I then look at the debt level, right? So is the company using too much debt? If the debt to equity is below 1, I'd say, hey, it's not too bad. But if it starts to be above 1, if it's 2, if it's 3, it's 4, then it's heavy leverage, in my opinion. And then the net debt over the EBITDA, right? If it's below 3, I would say it's healthy because it means that how many years of operating profit is needed to repay the debt, right? If it's become like 5x, 6x, 7x, for example, then I'll say, hey, look, it's very, very dangerous, right? Because some sudden event can wipe out this company. And then the last one I look at is the current ratio, right? So looking at the current assets over their current liabilities, is it above 1? Is it above 1 because there's enough liquid assets that you can sell if necessary to pay short-term bills, right? So these are the 6 things that I look at, right? If the company passes all these 6 things, I would say, hey, the financial health looks pretty good. And then the last one I look at is the futures earning growth. So a company can be very strong in growing over the last 5 years, but can it continue to grow over the next year? Can it continue to grow over the next 3 to 5 years? Right? That is important for me to understand as well. Right. And the way I look at it is really through the analyst estimates, right? And for most quality companies, I think 8 to 15% is really very strong in my opinion. Right. Anything above 15%, I will start to question and say, hey, look, what's driving this 15%? Is it speculation or is it really because it's a growing industry? Right. And in order to do that, you can use free resources out there like Yahoo Finance and Finviz, right? My preference is to use Finviz, and if you go on Finviz under the stock detail tab, you can see many different ratios, right? You can look at price to book, price to sales, price to earnings, for example, return equity, return assets, right? But I'm interested to understand the earnings per share, right? So earnings per share next year is 7.6%, and over the next 5 years is 6.23%. And not too bad for Coca-Cola because it's already a very mature company, right? It's been there for many years, right? So you can't expect it to be growing at 10%, 12%, 13%. So to me, 6% is pretty good. It means that analysts are optimistic, right? They believe people will continue to buy Coca-Cola products. That's important. Okay. So basically, that's it. I'll just wrap it off with this one-page the cheat sheet that I developed. So how do you judge whether a business is good quality from a fundamental perspective? Number one, you look at the economic moat. If it has a wide or narrow moat, you are pretty safe. You look at the financial health. Is it growing, right? Over the last 5 to 10 years, is the revenue growing? Is the net income growing? Is there positive cash flow? Then you look at the debt, right? Is the debt levels healthy? Nothing crazy. They are not taking on too much debt. It seems that they are able to pay off any obligations they need to. It passes the financial health check. Then I look at the last checklist, which is the future growth. So the business is strong and safe today, but can it continue to grow for the next 3 to 5 years? I look at the analyst estimates from Yahoo Finance, from Finviz, for example, and anything that indicates a growth of 8 to 15%, it's good for me, right? And once it has a strong moat, it has healthy financial health and reasonable future growth, I would say, okay, good. It looks great now. Now I would look to see whether, hey, is the valuation cheap? Does it look attractive to buy at today's price? And that will be covered in another video. So, all right, again, friendly disclaimer here. This channel is for education purposes only. It's not financial advice. If this was helpful and beneficial, do help me to like and subscribe because it will help to grow this channel for me. Thank you.